The other top story today, the Federal Reserve. Did you forget? Well, Federal Reserve policymakers are not expected to change the nation's benchmark interest rate at their meeting today. Gold, though, is up the most in a month. The dollar's down as investors wait to hear what the Fed has to say and really how they say it. Joining us now is Alan Sinai, chief global economist with Decision Economics. And our economics reporter, Bloomberg, Alan, was joking as to who would get the front page of the paper, Tiger Woods or Brent Bernanke. But given the reporting, the lead up to today's Fed meeting, it looks like probably Tiger Woods, because no surprises expected today from the Fed. Would you agree?
Even if there were a surprise, I can bet you that the Tiger Woods story would win.
Okay, so let's take it from there. I mean, how could the Fed surprise us? Perhaps, as, again, Michael McKee suggested, raising the discount rate?
No. I think the language on the interest rate will stay the same. That's the exceptionally low interest rates for an extended period of time. There is dissent on the Federal Reserve, though. Tom Honig wants to change the language because the economy is doing well enough for him to think that they ought to start to move rates up within 6 months rather than 6 months or beyond. So if they don't say something or change that sentence this time, I really think they'll do it next time, because it will be by the summertime, late summer, it'll be time to start normalizing that interest rate and raise it a little bit.
So where do we stand here? How long exactly is an extended period?
Well, some of the Fed members have said 6 months or more, and here we are in March, so that takes us into the autumn. And I think 6 months is about right. So if they were to change the language today, again, there's some chance they might, but probably next meeting, which is in May, then that pretty much telegraphs some hike in interest rates in the fourth quarter. That's where the consensus is. That's where we are. We're expecting to see the federal funds rate. They won't raise that at the start. They'll raise the rate on excess reserves, and all short-term rates will go up with that. But the funds rate at the end of the year probably will be in a range of 50 to 75 basis points.
Boy, mentioning that tool, right? Talk about some of the other tools the Fed has, and also its plans to unwind its balance sheet, this so-called exit strategy. Where does this plan stand?
Well, they have three divisions of items. One is liquidity, and they pretty much have wound down all the liquidity facilities that were emergency facilities, except for one that goes out a bit of time. That's done. Then they have the asset purchases that they made, mainly treasuries, mortgage-backed securities, and agency securities. In a balance sheet that's $2.3 trillion, there's about $2 trillion of this stuff. And they're through purchasing the treasuries. They're going to be through purchasing the mortgage backs at the end of this month. They will reiterate that in their statement today, I believe. And then they've got to start selling them and taking them down and reverse repoing them into the banking system and sop up excess reserves. That is going to be a tricky business. How fast they do it, how the markets react. We should start to see that beginning in April and lasting probably through the rest of this year. Tricky business to remove reserves from the banking system without upsetting interest rates in markets.
Do you think that will happen? Will we see a sharp rise in interest rates? Or does the Fed need to extend some of these QE programs, the buying of mortgage-backed securities and whatnot?
Well, I think it'd be a mistake to extend it, because already we're all worried about the long-run inflation fighting of the Federal Reserve. So they shouldn't extend it. It's a question of how they withdraw it. And the odds are that they've got over $1 trillion of mortgage-backed securities on their balance sheet, and that's up from last June, $400 billion. So they've bought a lot of mortgage-backed securities and agency debt. The withdrawal of that, or stopping the purchases and then selling it back into the system along with treasuries to get their balance sheet down, I think is going to put upward pressure on long-term rates. So we're expecting the Treasury 10-year yield to be, by the fourth quarter, in the 4.25% range. It's around 3.7 today.
So now, Alan, what's going on with the price of gold? It's soaring another 1.5%, $1122.60 the ounce, as there's not a lot of concern for inflation. In fact, I guess latest readings have shown inflation coming down. So again, why is gold so elevated?
You know, we've been bullish on gold as a firm since it was at $350. And we are continuing to be bullish on gold as an alternative asset investment, as protection against the currency erosion, particularly the dollar. Gold is a hedge against inflation. And the reason the gold price is strong and the world wants to buy gold is, one, the main countries, the U.S., the UK, Japan, main countries, their finances are in terrible shape.
Alan, I'm so sorry to do this to you. We have to get to our break. Run out of time. Alan Sinai of Decision Economics.